Good afternoon. I'm Kevin Peel. I'm here with our retail team, with analyst Jeremy McLean and sector head Brian McGough as they discuss why they think Kevin Plank should be fired. As always, we'll have an anonymous question and answer session at the end of the call. Email qa@hedgeye.com with any questions you have for Brian. Before we get going, allow me to read a brief disclaimer. Hedgeye is not a broker-dealer and does not provide investment advice to individuals. This presentation does not constitute an offer to sell or a solicitation of an offer to buy any security. This information is presented without regard to individual investment preferences or risk parameters. It is general and does not constitute specific investment advice. This presentation is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. For more, including terms of use, please go to hedgeye.com. Without further delay, I'll hand it over to Brian.
Thanks, Kev. Although we're going to have questions at the beginning of the call, not at the end of the call.
True.
So look, this is all about Kevin Plank, why I think he should be fired, why he should fire himself. I don't have any slides as I usually do on this, so please ask any and all questions. I'll just say it's a company that's got a leadership problem, big leadership problem, has a product problem. I think it has a brand problem. It's got a distribution problem. It has a big earnings problem and a cash flow problem. The whole cash flow thing probably isn't on radar screens, but I think they're going to have to take on debt. So it's going from a growth stock to a value stock, and I'm getting to a value in between $5 and $10 as far as when I'd actually get interested in owning it. I just want to be clear about one thing here. This is not a pound the chest type call. Hey, I was right. I was not long it, but I bought into the whole like short avoidance call. You know, Chip Molloy's there. He's a rock star Top Gun pilot. He's not going to miss a quarter because he never has in his life. But it is really, looking at it now, I know everyone downgraded it. Everyone hates it now. Stock could still get cut in half. So with that as a backdrop, Kev, want to ask the questions and I'll do my best?
Yeah, absolutely. First one here, did Molloy get fired or did he quit? What are your thoughts on him in general?
I think he quit. I don't know. It's like all opinion. But I mean, look, this guy was a Top Gun pilot. If you meet with him, he is like a rock star, probably overqualified to do any job in corporate America. I mean, if the government could trust him to shoot down a MiG, like I'm thinking maybe he could be like a co-head of Under Armour or essentially run their essentially the balance sheet. He did a lot of great things in his first year. Payables up, 21 days, et cetera. But I mean, whether Kevin just couldn't take him or he couldn't take Kevin, I mean, this guy is basically the Navy equivalent. He's basically like a Navy SEAL, right? He can take anything, and he couldn't take Kevin. It's bad, really bad.
And then just going on that, can you expand a little bit on this leadership problem?
Yeah, so Kevin is, can anyone argue he's done a great job? But I mean, and just kind of stepping back and looking at this kind of on a base level, this happens all the time. Kind of happened with Ralph Lauren, happened with Phil Knight, happened with Mickey Drexler over at J. Crew. Like, you get to a point whereby you build a company, you build a brand, managed with a pretty heavy hand, and the company just cycles. It goes from infancy into being a toddler, and then toddler into puberty. Anyway, and then it becomes a teenager, right? And then an adult. And now it's going through one of these stages. And Kevin is just not the guy for it. He manages with such a heavy hand. Here's a stat for you. These are numbers Connor whipped up. There have been 20 press releases in 10 years about people being hired at Under Armour into executive roles. 2 are left. What does that tell you?
Yeah, that's not.
That's a leadership problem.
Very true. Next one here. How do you get to a sub $10 stock?
Okay, so when Jeremy and I went through this model, we usually don't fall victim to it, but this is the kind of name where if you're on the sell side, you go through your model, you kind of straight line growth in perpetuity. We've got growth going from 25% down to 10, and maybe in a single digit number, even with footwear growing, with international growing. In the past quarter, apparel in the US was down. I can make a good case as to why 3/4 of the growth here have come from outlets, and outlet growth is tapped out. So if I'm any growth manager out there, And I hear Kevin on the call, he's like, yeah, we're just not a growth story. Really? Like, you don't say that. You don't say, hey, we're transitioning into a margin and value story. That's like a death knell. The stock is ridiculously expensive. But if I'm a growth manager, one who's actually put up numbers, am I going to buy this? Keith would never in a million years buy the stock when the revenue is rolling over, ever. And it rolled, and it's under pressure. If that top line is going like this, or the rate of growth is going like that, it's in valuation purgatory until it actually becomes a value. But with the balance sheet probably delevering, I've got margins going from, where are they now? They've been at about 10, right? That's kind of been their run rate. I've got them going to 3.5. So really, really big. I've got them earning, in 3 years out, I've got them earning 21 cents. The street's at like 90. Stock's trading at what? 40, 50, 60 times earnings. You pick a multiple. I mean, this is like, you can very easily get to a single digit stock before like Joe Long Only wants to step in and buy 5% of the company.
Got you. Next one here, do you think there's a brand problem at UA?
I don't know if there's a brand problem. Like, this is a great brand. All right, it's a crappy company, but it's a really good brand. Those two can't be that way in perpetuity. I think they have a product problem. So, well, I'll start. I think they have a distribution problem. So here's a stat for you, Jeremy. It's something like their apparel business in the US is like, what, 3.5 billion? 3.6, something like that. Nike, right? Nike has an apparel business in the US of 4.7 billion. You have only $1 billion delta, $1.5 billion, call it, in between these two companies. You got Under Armour, who, of course, Sports Authority closed. It's bad, 5% of the distribution, but they filled it with Kohl's. And you can say, okay, Nike has done the Kohl's thing, and I get that. Even Ralph Lauren did, but those guys tier their product really well. Like, you got one label going here, or a $180 shoe going here, and a $90 shoe going into Dick's Sporting Goods. Actually, I think this is Dick's bullish for a whole lot of reasons. And Nike bullish, and probably Foot Locker bullish, which is new for me. So anyway, they're tapping out of distribution, and that is a problem. As far as the product goes, this is where it's kind of interesting. I mean, if you look at Nike, they've got the brand designers, like up top. It's like a triangle. So you get the brand designers up top, you get your guys, they're called PLM, right? They're over in Asia, or they're actually here, but they work with Asia in order to reverse engineer the shoes, in order to get a good margin at a good price. And then you get sales and markets it, right? At Under Armour, you've got scientists, like NASA scientists, who make the product. So you can look at an Under Armour like hoodie on a shelf, and you look at a Nike one that's right next to it, and they'll look pretty similar. But with Nike, with Lulu, they actually care about like how it feels on your body. And Under Armour, the product guys will be like, no, it's a great material and it looks good, and that's all that matters. And it's a legacy from back when they just had the compression stuff. And their entire product engine was all about a close-fitting, kind of make you look cut even though you're not type product. Mm-hmm. They have a product problem. And with the product problem comes a distribution problem. They go hand in hand.
Okay. Moving on here, next one. Can't DTC help mitigate downside support?
I mean, the answer is yes. So their DTC, outside of wholesale, is what, twice as big as Nike's is. I mean, Nike's in the teens, Under Armour's hovers around, say, 30%. The difference is, like, if you look at Nike, I could argue, and I did argue, that of $2.6 billion in incremental EBIT over this cycle, about $600 million of that was Nike's outlets. About $500 million of Converse. I mean, there's like 4 things with Nike which account for like 80% of its operating profit growth. With Under Armour, I can make an argument that it's a lot more than that. So if I go through some math, generally speaking, so Under Armour's added what? $4 billion in EBIT over this cycle. They added $4 billion in revenue over this cycle, like 335 in EBIT. In DTC, it's added 1.3 billion in revenue. It's added 253 million in operating profit. The point there is that about 3/4 of its EBIT actually came from DTC. They've got 188 outlet stores. there's kind of a general rule in retail where once you get to your 201st outlet store, like you click the sell button. Because outlets are so profitable, and they've been ramping up outlets year after year after year, and they should. They totally should, although I would argue that now the internet is kind of your new outlet. So you marginalize your profit center. I think overall it's good and they have to be here. I'm just saying that the rate of growth and profit from outlets and from DTC is slowing. I mean, it's slowing a lot.
Next one here. Will the company accelerate or slow down spending? Sounds like the latter. Will UA have to spend more money on athletes?
Okay, on the spending, they said something on the conference call. And this is the interim CFO who actually made the most sense, I think, of anybody on the call. I mean, Chip Molloy, he's your Top Gun pilot. He just sounded pissed off on that call, which kind of makes me think maybe like he was fired, but I don't think he was. So the interim CFO, whose name I don't even know, he was like, look, we're a $5 billion infrastructure built up for $10 billion. I actually don't think they are. But 3 seconds later, he says, we're going to streamline and we're going to evaluate our capital spending. Like, when you're a good company, right, and you're seeing any kind of pressure, you spend more money. You spend more money in order to go on offense again. If these guys are taking down their capital spending, which it sounds like they are doing, or they're taking down the rate of growth in cap spending, in fairness, it's just bad. It's just really bad. So, I mean, that's on the balance sheet. I mean, it flows through the P&L, obviously, with your depreciation, but if you're going to look at, say, athlete endorsements, you've got Nike that's got like $6.5 billion in athlete endorsements off balance sheet. And by the way, like operating leases, those come back on balance sheet starting in 18. So returns are going down across the board. Under Armour has $350 million in endorsements on off its balance sheet, I should say. And the interesting thing about that, I think, is that if you're Nike, you had like no innovation this past year. There were people fired at Nike. Like you can't miss a Nike, and they missed. So what do? They spend money. SG&A is going back up again. Their CapEx is going up. They're acquiring athletes. They can acquire assets out there equivalent to the entire size of Under Armour's annual budget and even its forward budget, $350 million. You would not even notice if you're Nike. You're going to notice if you're Under Armour. So are they going to have to do more marketing, more athlete endorsements? Are they going to have to do a soccer club, football, whatever, over in the UK? Or yeah, they're going to have to. I think we've known that forever. Everybody has, like, yeah, the cost of growth is going up. Yeah, they just admitted it about 95 days ago. But they're going to have to spend more. If I'm wrong on them doing a 21-cent earnings number, it's probably because they do the wrong thing. So in saying that, I mean, if they take down spending, they're going to get a near-term pop in margin. But it totally questions top-line growth in year 2, 3, and 4. That would be a problem. So we definitely have to game this. There's kind of what they do to print a number versus how much they put into the business. And without question, they should accelerate on the SG&A line. They should accelerate in their PP&E line. They have to do it. That's the only way guys like me could actually go around and make a case saying, yeah, this is a growth story that's just in the tank. Like RH, and I get it, I blew that one. But I mean, they're investing so much right now. They're stepping on the gas pedal with every form of spending. They just screwed up with execution. I can still make that call, even though I got no credibility on it. You can't make that call with UA or UAA or whatever that gets called now.
What do you think is the biggest difference between Phil Knight and Kevin Plank?
Age, one. Phil started an industry. He started an outsourcing model, started an offshore model that all of retail copied, as they should have. I mean, look, Phil knew his limit. Phil didn't sell a share of stock until he was 65. Didn't sell a share. Kevin started selling when he was 35. Kevin might be one of the youngest billionaires in the country, but he peeled money out of Under Armour early. He loves racehorses, and I don't know what his aspirations are in life. They're probably not in running Under Armour, just not yet. Is Kevin on this call right now? No. One, I didn't invite him, but he's kind of a resourceful guy. Could he get on it? Of course he could. I don't think he cares. If I were a good CEO, I would want to see what someone says when they're saying, hey, you should fire yourself. Phil knows his limitations. So he basically came out, 5-6 times over the course of 20 years, and he kind of fired himself. Twice in the 80s, I guess that's more than 20 years ago, but twice in the 80s he handed the keys over to another person who ran the company. In the 90s he did it with Tom Clark. He gave it to Bill Perez, which was horrible. In 05, 06 he gave it over to Charlie Denson, Mark Parker in like 01, and he gave it officially to Mark Parker, 6-7 years ago, whatever it was, 8-9 years ago. Anyway, the point is Phil knows when he's got to run the company, he's got to get in, and when he could hand off and let other people make decisions who he empowers to make decisions. Kevin scares the crap out of everybody. If like, I told IR, I actually gave IR this note, the note I wrote yesterday, which was scathing. And I told them, I said, and I usually don't give anything to any companies. And I told them, I said, hey Lance, I would encourage you to give this to Kevin. And I'm interested, you've been on the job for 3 weeks, are you comfortable giving it to Kevin? Or is he will he yell at you? I.e. like, why do you give me this? Or, this is your job, you gotta stop this. Like, and that's really good. So like, that's the kind of guy Kevin is. I remember back in my Morgan Stanley days, he was on and he ripped our research for saying that his returns were eroding. And he was like, this guy used to work at Nike, he hates me. Guess what? I don't care, I was at Nike, it was right. His returns went down and his multiple went down until it went up again. But I'll leave it at that.
Fair enough.
Oh, I will say, Kevin, to his credit, he stepped back a number of years ago and he gave the keys over to David McCrate, who is really, really good exec. He's now over at Urban Outfitters, which is has been in trouble and is probably still in trouble. But David, over the course of about 2 years, he got everything right, he fixed it, and I don't know if he was fired or he quit, but he left. And I think what Plank said is, hey, there's another guy who came in, he fixed it, now I got the car keys again. I'm not even 40.
Gotcha. Was there anything you liked out of the print?
I like the cash flow, right? I mean, there was really good cash flow. I mean, I think I got these numbers here somewhere. Cash from ops, I don't know, Jeremy, back me up.
It was
right or wrong?
up like 30-40%, something like that, pretty high. Just under 400 million in the quarter, which supported by payables, which was a little interesting. But
Little. I mean, it was up 22 days,
Yep.
right? And so at the same time, their cap spending was down. So the free cash flow was up like 65%. I mean, that's great. But again, it augurs to, is this a growth story? Cash flow never mattered with Under Armour because it grows like a weed. And I'm not saying it's bad to have good cash flow, but you got to rely on that cash flow being there. And it's not going to. As we went through our model, we fixed their balance sheet, their payables, their working capital, their PP&E. I got to a negative cash balance of $500 million. I mean, they're going to have to tap into capital markets, I think, for up, $600 million when they have no CEO, CFO. It's a problem.
Yeah. What do you think of the next catalysts for the stock?
Growth slowing. Like the opposite of our macro call, right? I mean, growth accelerating. This is growth slowing. This is still a company that has a 50 multiple. Growth slowing, no one's going to step in front of it. So the catalyst for the stock is, I mean, sometimes the absence of a catalyst is a catalyst. And I know it just got cut in half, actually more so over the course of a year. But just the absence of growth, having zero reason to step in and buy it, having no one steering the ship who's worth their salt, not as far as being like a brand rah guy. Kevin's awesome at that. But who's an adult in the room who could actually get this thing going in the right direction and put in a real infrastructure, empower people, encourage people to take risk. You got to have that when your sales are slowing, especially when the company's going through puberty, I'll call it. So I think a catalyst is just still growth slowing. Occasionally numbers continuing to roll over again and again with expectations still numbers being too high. I know you had 8 sell-side downgrades. That's embarrassing. Happened to all of us at some point in our careers, but you had a lot of downgrades. There'll probably be more I mean, the short interest is high. I get that. It's probably going up while the stock goes down.
Gotcha. Next one here, Nike, Foot Locker, Dick's, Adidas. What are the implications here for that?
So first off, with Nike, it traded down a lot yesterday. Doesn't matter. Like this is not a space problem. This is not athleisure is over. Nike's revenue is accelerating. Under Armour's is decelerating. Am I making a market share call? No, I'm really not. But it probably gives Nike a tiny bit. I don't care as much about market share with Nike. That call has nothing to do with Under Armour. Under Armour can still double its shoe business, and it won't touch Nike. It's not about Steph Curry. I don't care about Curry. He's such a small piece of the business, but a big piece of the share of voice. I just think Nike's model has inflected, and sales are going up sooner than people think. I think margins are getting better sooner than people think. SG&A, it's still going up, but the growth rate is rolling over. The cash flow is it's just the path there is to $5 in earnings with Nike and the street at $3.90. With Under Armour, the path is to 21 cents in earnings with the street at 90 cents. Foot Locker, a little bit different. I mean, when you have a desperate brand, it's always good for the retailers. Sports Authority just went under. Dick's Sporting Goods is it right now. And I don't think it's in numbers. I think Dick's is going to do well, and we've got a deck on that one in another week or two. Anyway, so I think Dick's is in good shape. Under Armour needs them a lot now. I think Foot Locker is interesting. It's kind of, I don't think it's an Under Armour thing, but if you're Foot Locker, almost 3/4, 72% of what you sell in your store is a swoosh on it. I'm convinced that's going down to 60 until it probably goes lower over a tail duration. That doesn't matter right now. Nike, as they accelerate their near-term top line, they're giving exclusives over to Foot Locker. There's like a LeBron retro that was initially only launched in the Foot Locker store on 34th Street. I don't care about that one shoe. It's not going to be that effective and that impactful, but it's more the gesture. And that gesture, I think, is really big because if you're Nike, you got to come out with product, which you can do fast. You tap into 45 years worth of stuff, you pull them out, you refresh a colorway, you market it. They can't get that through their DTC pipe yet. They can get it through Foot Locker's pipe.
Gotcha. Next one, you just mentioned this. What's up with Curry? Does it even matter?
No. Next.
What part of this event does the equity market not understand?
That this company is levering up. And I don't think it's about earnings anymore as much as I said it. When something trades at a 50, 60 times earnings multiple, whether it's on the consensus numbers or mine, clearly there's some other stock driver, but it's, and I'm not going to try to game, hey, who's going to buy it here, who buys it there? That's not my job. My job is to get a stock right, and it's to give, I think, to offer up and to give our clients deep research on issues that they might not be appreciating. I think the big one, if I were to call anyone here, one brand problem stemming from a product and a distribution problem, that's not fixed in a quarter, a year, maybe even 3 years. Without the right capital investment, that's not happening. Opposite's happening, which will lead to the company having to lever up. Not like Hanes Brands lever up, but it's debt in a space where you really can't have any net debt.
Next one, do you see them backing away from any sports? Example, golf, tennis?
No.
Do you think the athletic category is dead? Any read-through to Lulu?
I hate Lulu, but I don't hate it because the category is dead. I think a good category is booing a horrible management team. In the case of Lulu, I think the category, this is like a kind of a big misnomer. I think a lot of people think that the category is just good, and it is good, but I think they think it's good because the consumer wants all this stuff. I don't actually think that's true, at least from a starting point. This is a space where the tail wags the dog, right? So if you're Nike, if you're Under Armour, if you're Adi, and you're spending money on R&D, if you're spending money on marketing, you come up with great product, you convince the consumer that they want it with a great marketing message, and you got the distribution pipe to sell it, your cycle perpetuates. There's really no cycle. It's when the brands decide they don't want to cycle anymore. When the cycle ebbed last, it was when Adi and Reebok merged. And you had two companies, 8% share each, They merged, they turned into a company, a parent with 8% share. They handed it right over to Nike. It didn't have to spend money in the US, spent it over in Europe, spent it in Asia, gained share over there, gained share here. Who's better than them? So, again, I think, Kevin, it comes down to the whole tail wagging the dog. Tail's still wagging. Under Armour or no Under Armour?
Next one here, Nike sells in Kohl's. Why can't Under Armour?
I think I hit on this a little earlier, but Nike does a really good job in tiering. So by tiering, there are companies who do it really well, right? Ralph Lauren does it really well. You have Chaps that sells in Kohl's, you have Black Label that sells here, you have Blue Label that sells here, and then you got like a Melania Trump wearing a $60,000 dress at the inauguration. Like, you can't get that in Kohl's. They tier it really well. With Nike, you go to their sneakers app, SNKRS, you'll see a $200 shoe. They'll tell you if they're going to give you the privilege of buying it. In their own stores, you have $180 shoe. In Foot Locker, $160. In JCPenney, you got like $50, $60, $70. It's low, right? So they do that really well. Under Armour does not do that. It doesn't know how to do it. Lulu, once it builds a wholesale model, and it has to, hit the sell button. I mean, that's problematic, really, because they don't have any kind of differentiation. Like if you're Sweaty Betty, which is a brand that it's a UK brand, but it's great. They differentiate really well, wholesale versus retail. Carter's, horrible. This is in part why I'm short it, because they sell the same stuff in Kohl's, Penny's, Macy's, own stores, their own online, Amazon. Their wholesalers are selling the same stuff through to Amazon. Same exact product at different prices. That's not sustainable. Same exact thing with Hanes Brands. Hanes Brands is still my best short, no question. I don't know, maybe I'm jittery into the print tomorrow, but this is a $22 stock, which I think is going to 5, 6, 7. So I don't know. I hope that answers the question. Are they invested to do it or not? And they're not.
Yeah. One more here. What do you think was the most troubling anecdote from the call? Kevin standing up there just sounding so confident. He tried to eat a piece of humble pie and like he threw it up. He's just, there's no humility. Him standing up there in the first 5 minutes of the call saying, hey, I have a whiteboard in my office, everybody. I wiped it clean. Now I'm just, like, Kevin, really? We have whiteboards too. I didn't use it. Put it back there. The lack of any form of humility on the part of Kevin, that's probably a consensus view, but it doesn't mean it's not really damning. And I gotta think, if he's got his best face on, right, and he's on best behavior when he's talking to you and me and the probably 1,000 people who dialed in and saw the webcast, what's he saying internally? How is he tearing down his people? I mean, this is a guy who I'm thinking has probably made people cry in management meetings. I mean, really rough guy. Maybe to a certain extent, that's a good culture to have at a certain point of its overall evolution, right? It's like a football team. Bam, that's his whole DNA, and he's awesome at it. Just not for running a company. I mean, the dude has got to step down. Yeah. If he stepped down, the stock would be up that day, but I would buy it. I'll close on this. You can't look at him versus a Phil Knight. You have to look at him versus Chip Wilson at Lululemon. Like that loose cannon, he was bad news. He was very appropriate for a certain part of the brand growth and maybe the company growth, sort of. But he was very wrong once it got to a point where he started to call his customers fat and he had to like manage a much, much larger business. Kevin's not calling us fat, even though maybe I am a little bit, but he's just not doing the right thing. And in fact, he's very much doing the wrong thing. That's all we have in the queue. Next time you put a note out saying fire Kevin, give me a heads up. Troubling to look at this morning. But yeah, that's all we have. Thank you,
all right.
Brian. Thanks, Jeremy. And thank you,
guys. Everybody, thanks.